And we are live, folks. Just wait for a few of you to join on, and we will get started with tonight's broadcast. Yeah, lots of things to talk about. Cool. So lots of things to talk about today. Got lots of news articles. I think I've got like maybe 10, 7, 8, 9 articles. So 9 articles today to talk about. I'm going to talk about the interest rate decision today. Going to talk about the economy, what I'm seeing out there in the economy, what I think is going to come next, and lots of cool things. So let's just jump straight into it. And also the topic of discussion today is how does your investment journey differ with age? If you are 18 getting started, if you are 25, 35, 40, 50, 60 getting started, what is different? So we're going to go through a bit of a deep dive through that. So if you have any questions on that front, please feel free to flick them through over the course of the night. So first one here, article here from ABC, Australian Broadcasting Communism. Tens of thousands more jobs must finally crack this cost of living crisis, economist says. So it says here, in short, economists are concerned about mass job losses after the latest official data showed the economy is slowing to a crawl as interest rate hikes temper demand. Economists say shows the Reserve Bank's restrictive monetary policy is working, but what happens if some of the more elevated prices in the economy don't come down towards normal levels? What next? Labour market. Economists say it will be critical to watch how the jobs market evolves over the coming months and if there are any increases in long-term unemployment. It means at least for the next few months, Australia avoids technical recession, which is defined as 2 consecutive quarters of negative growth. Deloitte Access Economics partner Stephen Smith says the newly released data shows that while Australia is not in a recession, many Australians are in a recession. And if you're going to look at just out there in the economy, speak to your friends, family, everyone's sort of doing it tough apparently, right? I'm doing great. Obviously there's always challenges that we'll have in life, and we go through times where we have different sort of challenges that we're faced with. But some people are doing it very, very tough out there. So looking at the economy is just when is that going to break? And I think we're right in the eye of the storm for that. We've got the banks around the world starting to collapse. We've got currencies around the world starting to collapse. We've got the whole financial system. People think that the Dow Jones is up, ASX is up, paper asset markets are up, Bitcoin's up, everything must be doing fine. But that's not translating into the real market, and that is where people are being deceived. And eventually, they're going to be robbed in one of two ways. Either purchasing power is going to be diminished, or they're going to push us into some sort of technical recession. So I do want to go through my next article. This one here is an article, I think it's from Accountants Daily here. This one here is the tax office targeting DPNs at directors with high value assets. One thing that I have noticed over the last 6 months or so was with the ATO. They are very, it says here, let's go through the article. It says the ATO is increasingly using data matching tools to identify which directors have assets to meet director penalty notices according to an insolvency firm. So it's kind of interesting when, 2 years ago, 18 months ago, whatever, they said to people they had to vaccinate their business, let's call it, and they had to enter themselves into a new database in their business, and suddenly they've got all this data matching stuff. Suddenly they're chasing like never been beforehand with anyone. You've got to question, how do we politically correct say this, right? I'd love to say certain things, but might just keep it to myself. But if we look at, if they're chasing so hard, why are they chasing so hard, right? The government naturally has spent a lot of money. They've had to take on a lot of debt. Do they have the capacity to pay their debt? Is the country solvent? So this article just goes on to say the tax office is increasingly focusing on director penalty notices on directors that it identifies as having the assets to meet the DPN through its data matching tools, say insolvency. So they're pushing, basically the ATO is pushing businesses to blow them up at the moment. And if they feel that they can blow up the business or take their assets in the meanwhile, what they will do is issue a thing called a director penalty notice or a DPN. And that DPN means that the director becomes liable if the business doesn't blow up. And that's why a lot of businesses that you're seeing in the news are just blowing up the business before those director penalty notices do affect them. It says here in the first half of 2024, around 30,000 DPNs have been issued. It says here, where are we? I don't know if it was this article or if it was another one. This is about the insolvency of the business. No, that doesn't show up. But basically, they're pushing and leaning on people. Remember, in the US, they had armed tax agents, IRS agents, which are to collect tax, and I think it was like 96,000 new staff that were employed at the IRS. So, yeah, one of my friends sent me a meme this morning, and I'll write the meme just so you can see it. Right? It's pretty funny. I don't have it here, but it says it's got like the accountant. They go to the accountant's office, and they're sitting behind a counter, and it says, the IRS, and the husband goes to the wife, yeah, see, it's theirs, right? Because they just want to take and take and take. So anyway, just to understand that the pressures that are out there in the business world, they're not letting go of that, and these are the sort of things that happen in GFC. A lot of you may not have been in the financial markets at the time. A lot of you may not have even been born, or you might have been in primary school, or whatever the case may be. In the GFC, things got very bad, and they had to try and get their money in somehow, and they couldn't get their money in, so they started certain tactics, and it all puts pressure on. That's why the previous article that we're looking at there about the tens of thousands of jobs must go before we start to see the system crack. That's sort of where we're heading to. And this one here, talked about for a very, very long time. This is an article out the other day from, I think it was news.com. It says, Australia should prepare for the death of the middle class, experts warn. Australia's middle class is dying thanks to policy failures, the housing and cost of living crisis with the rise in wealth inequality, experts warn. Australia should prepare itself to mourn the death of the middle class as the once famed land of opportunity and birthplace of a fair go transformed into a state of where the only way to get ahead is to have rich parents. That's the warning of the economists, investment experts, and social advisors, blah, blah. Both renting and buying is now so expensive that we've gotten to a stage where the majority of people able to buy a home can only do with parental wealth. That's an interesting term, parental wealth within itself, because it sounds like it's some sort of privilege to have parents that own their own house that you can go and tap into their equity and whatnot. So you're looking at it, it's definitely getting much harder out there for people starting to get ahead in life, whether they're first home buyers starting up with the property or whatnot, but the deals are still out there, and I'm not here to spruik deals that I'm working on at the moment. I wrapped up quite a few in this last week, and there's a lot of people out there wanting to buy and buying those cheap properties. There's no shortage of people wanting to buy them, or ability of people to be able to go buy them, because they do service for low levels of debt very, very easy. But buying a property for $100,000 or $200,000, been buying in capital cities, Brisbane, Perth, Melbourne, 150, 200, 250, 300,000 price ranges. They're still out there, but the average property for $1 million, $1.5 million, just get a red brick or a fibre house. This one here, article number 4. I think a lot of people need to be looking at this one. Specifically, I'm a big fan of commodities. I think there's great opportunities out there. Might be some glitch in the next 6 months, 12 months, 24, 36 months. I was reading an article the other day about, what was it? I've got a mind blank. Copper nickel. So in 2007, before the GFC, nickel went way up, but when the GFC came, the demand for nickel had gone backwards, and I don't think we're going to see the demand for nickel dry up in this market, but it just goes on to show that BHP had closed down mines and abandoned, I think it was BHP, had abandoned mine projects and basically blew up the project and said, no, we're going to walk away from it. So China is obviously falling, crumbling. I reckon if we were to compare China to something at the moment, it would be the GFC of the US, but it's happening in China. And with that comes lack of building and the demand for certain metals or minerals. And the mineral that's the flavour of the month is iron ore, because they need that for steel production and whatnot. So, yeah, looking at bargains that might pop out there, I don't see it at this point in time. But if we start seeing some mining companies retreat from their aggressive behaviour on mining certain minerals, then there could be closures, there could be bankruptcies in certain mining regions, and that could create opportunity, not today, maybe in 4 years' time, 3 years' time, 5 years' time, but just something to put on the radar for in that period of time. Know when to get into a market like that and know when to get out of a market like that. So yeah, with it, the 5 Ds that China has, give China the D. It says here, slog its way through a severe downturn, more charismatic of the Great Depression, with Chinese characteristics than business as usual growth targets. China is faced with 5 economic headwinds. Failing demographics as the nation ages at a very steep pace, accumulated debt from its historic urbanisation build-out, deflation that makes repaying the debt all that more difficult, deglobalisation that robs it of an external release valve, and a dictatorship. Says that their property is in the black hole. The easiest way to understand China's depression economics has happened at its property market only a few years ago. Chinese households invested in new apartments. It was thought that there were a horde of poor millions pouring into cities was endless. So supply and demand obviously kicks in. If you've got these ghost cities where there's no one there, then we've got an issue. A lot of people are complaining about the level of migration that's happening in the country at the moment, which is going to put a lot of pressure. And I think I've got an article to talk about that in my articles tonight. But the pressure that goes to our infrastructure, but the reason why we need to keep bringing migrants in is to stop what's happening in China from happening here. So I think there's a good exit plan. I'm not too concerned about that. When you start seeing locations, I reckon maybe the next boom, if we start seeing places happen like that, that's when we should start getting to a worrisome part. Another country that looks like that at the moment, I see all these ads that are around, is Dubai at the moment. They're putting ads up to buy stuff in places that look like that. That's probably the next big fad that people are going to be looking at. This one here is very important, just to be mindful of, right? Because it's not just mum and dad that's sitting at home with a bit of an issue at the moment. It's not a matter of mum and dad sitting there with a high interest rate that's going to bite them. It's if your employer doesn't have the business flowing through like they should, then it's going to bite, and you'll start seeing layoffs and businesses go to shit. Someone just said here, Chad just said, remember the last scene in Game of Thrones when she burnt everything to the ground? They will destroy everything. If losing looks likely, people will think we're going to transition to this new system smoothly. No, and I think throughout history we've never seen a system from an old system go to a new system. It's happened in a very seamless way. It's either done with aggression or it's done with poverty. And this is probably going to end up with a poverty-stricken one as people lose all their value. And I don't need to be on the depressive sort of front. I say it quite optimistically because there's opportunities to be had. I've got a question here that says, hey all, the 30-year loan, is it true that the first 20 years you're paying interest to the bank and the rest is 10 is principal? No. However, when you're paying down the debt, it has a much smaller effect because you've got you've got such a large debt amount, it compounds on itself. Probably the best way to look at it, some of the best calculators that I've seen, I'm not a big fan of this bank, I'm not here to spruik the bank, I don't even use the bank, I had an account with them when I was a kid, but they do have a really good online calculator, is St George Bank. So if you go and type into a St George home loan calculator, a repayment calculator will actually show you the amount of principal versus the amount of interest, which you could get an answer of what you're looking for there and see it quite clearly. This one here, business-to-business payment defaults reach record high as cost of living pressures rise. So let's just understand that B2B is business-to-business. Payment defaults reach record high as cost of living pressures bite. This is a record high forever, right? The latest Creditor Watch Business Risk Indicator reveals that the payment defaults from business-to-business transactions are at record highs as a result of increasing cost of pressures facing Australian businesses due to high interest rates. Due to high interest rates. So what did I say would occur 24 months ago when we started seeing talks of interest rates potentially going up? I said that we would see these costs would have to get passed on to someone, and it would exacerbate the inflation which is going to be around us. It says here, wage and labour shortages coupled with lower consumer demand. Why is there lower consumer demand? Because no one's got any money, they're trying to save their interest rates, and then it just creates a whole new saga. It's the opposite of what we've seen. So it's which way do they steer the car? And it's going to become more and more abruptly each cycle that we go through moving from here. Credit Watch research highlighted a strong correlation between payment defaults and business failures. Businesses with one default have a 24% chance of going insolvent in the next 12 months, rising to 42% for two defaults against two businesses and 62% for three defaults against three businesses. Credit Watch reported that last month the average value of invoices was at a record low, which was reflected in last week's ABS business indicators for the December quarter, which showed businesses were running down their inventories in anticipation of further declines in consumer demand, while the February BRI data recorded a seasonal increase in the average of invoices from January-February, up 10.4%. Values continued to trend downward and sit at the lowest point since September. Credit Watch CEO said the rise in business payment defaults and falling invoice values is a very concerning combination. So I think what they're meaning when they've got falling invoice values is that there's less accounts receivable in these businesses coming through, and they're filling up their pipeline. So it says here, trade payment defaults going up while invoice values decline is a real worry. This indicates that cash reserves are being depleted and margins are being squeezed. An increasingly number of businesses have less cash coming in, which means that they are then finding it difficult to pay their own suppliers, such as we are seeing a steep increase in payment defaults being registered on the Creditor Watch database. They're also cutting the size of their orders and running down in inventories. This payment defaults data provides our members with critically important intelligence about the trading behaviour of other businesses, some of whom which have extended credit too. So as one business blow up, then it'll flow onto the next business and the next business and the next business. The Public Administration of Safety, mining and electricity and gas, water and waste service industries have all recorded largest increase in external administrations against this time last year. There are numerous subsectors within these industry categories, such as security companies and waste management services, which are facing very challenging conditions and a slowdown in demand. Food and beverage service sector still has the highest rate of external administrators, and this sector is expected to remain its unenviable position at the top of this table. Australian pull back their spending at restaurants and on takeaway at the face of cost of living pressures. Business failures consider external administrations as well as ASIC strike-offs, so the closure of a business for various reasons. Over the next 12 months, Creditor Watch expects over 7% of all food and beverage businesses to shut down for good. So 7% of all food and beverage businesses to be shut down for good is what their estimation is, which is terrible, terrible news out there for people. And this is, one of the things that happens as countries and nations have been faced with hyperinflation, because there's a debasement of the currency. It's not that the business is being run badly or whatever the case may be. It's just simply that their cash flow is being spread and the businesses haven't been equipped to deal with those sort of markets. Or even, I often joke about trades, right? Some trades, come in and they're like, oh yeah, this is how much it's going to be when you're doing a renovation. And they know, like, they're just putting their own inflation in there, right? They're just, oh yeah, this is what it is, right? But there's some trades which don't understand what inflation is, right? And it's like, yeah, as a business, you need to understand how inflation works to be successful and be able to stay on top. So this one, he goes on to say, given the available data, the index expects the next 6 months to be a very challenging period for Australian businesses, such as businesses are reminded to be watchful of their cash flow very cautiously, even when their cash rate begins to decline, which is expected to happen sometime in Q3 2024. It has also been added that it will take 3 to 4 cuts to the cash rate before the Australian consumers start to feel more comfortable making purchases of discretionary items, which is unlikely to be until early 2025. So when you start overlaying this data, it does show a picture. So let's move on to the next article. I have seen that with Japan, and that is my next article to go to. We will get on to Japan shortly, and I'll talk to you about what I'm seeing happening over there. I've actually got all these articles that you're talking about. Matt says here, I just saw in the news a builder that has been around for 50 years went broke owing 20 million. How does this happen? We will get onto that. I'll dissect that for you very shortly. This article here, article number 6, is RBA rates decision, interest rate unchanged for the third meeting in a row as Australian borrowers granted reprieve. Oh, so lucky, guys, so lucky, right? Everyone has been given a reprieve. You should all be so happy. Interest rates remained at 4.35% or 435 basis points at the central bank. So, what do I make of that, right? Firstly, something has changed, and this didn't get brought to my attention until last week. I did a webinar last Wednesday. If you haven't seen the webinar yet, reach out to my team and ask them if you can get access to the webinar. I was on with Rose Renew from Sing & Finance, and we're talking about certain things with property market and finance and all that sort of stuff. But one thing I realised, right, so the Central Bank of Australia meets on the first Tuesday of every month. The first Tuesday of every month, for every month, 11 months of the year, bar January. So they don't meet on January, they meet in every other month. They're only meeting 8 times this year. So what does that mean? Why are they missing months? So I don't have it in front of me here, but they're meeting, there's like 4 months that they're not meeting this year, and they've put the dates at all different times, right? So it could be on the 5th of the month, it could be on the 16th of the month, etc., etc. So one thing I've noticed, like today is the 19th of March, and the 19th of March 2024, we had the rate decision, right? This ain't a Tuesday, the first Tuesday of the month, folks. Just remember that. So I found that within itself very, very odd that they have now come in and they have changed the parameters of how the system operates and how this information, how this news gets delivered to you. So I find that distressing, concerning, and everyone should be, why did you change it? Why did we need to change it, right? And I think that there's certain points in this year, as I said, on the 11th of March was D-Day from those banks. If you recall, last year, banks had exploded in the US because they pushed the rate up. The bonds were unvalued, like they weren't valuable, so the bondholders were disadvantaged, meaning the banks were insolvent. A lot of banks went broke last year, and they were bailed out by other banks. So a year on, the reason why they were bailed out is that they were given a 12-month temporary loan that bailed that bank out, and then the new bank took it over and they could do what they wanted with it. But the problem is that those banks that have taken on the banks that blew up are now in financial crisis themselves, and reflective of the confidence in what the markets are telling, because the stock prices of those banks, a lot of these are in the US, but they are in other sort of stock markets and financial markets around the world. These banks have now taken a hit and are falling backwards in their value. So on 11th of March is the date that rolled over of 12 months. And just like anything, on the first rate cut, we didn't see the market blow up and we didn't see anything happen. But after you give 11 rate hikes or 13 rate hikes or however many rate hikes we've seen so far now, it starts to pinch. So that date has passed, the 11th of March, and I expect that we're going to start seeing more destruction out there in the financial markets moving forward. And I think that some of these key dates where we're going to be missing meetings with the RBA meeting, there's literally months which don't have a meeting in them anymore. And I think those months are going to be very crucial dates that we would need to have, surprisingly, we're not here today, right? We can't give you a rate card, we can't do anything, the markets are frozen. So, just that's my first observation about the rate meetings for this year. Everyone should be questioning that, and I haven't seen anyone questioning that yet. So let's get into this article. This is one from one of the common websites out there. Australian borrowers have been granted another reprieve with the RBA holding its key interest rate steady for a third meeting in a row. So you can just say, we haven't changed it for 3 meetings, but really it's 5 meetings because two of them were missed in the middle of it, right? The RBA board left its cash rate unchanged at 12-year high of 4.35% after its second two-day gathering of 2024 concluded on Tuesday afternoon. The result was widely expected by economists. The central bank, though, has left itself the option of raising interest rates again if necessary. So they're saying they might increase interest rates, but if you go back to February of 2019, Philip Lowe had come out and he said the next interest rate movement will be up, will be most likely up. It's very prominent that it's going to be heading in an upward trajectory. And I said that between 90 and 120 days we would see that come down in reversal, and people said, Birch, you're off your head. And on the 4th of June 2019, interest rates came down for the first time, and that was reflective of what was happening out there in the market. So someone just said here, Philip Lowe is dressed up as a woman. Look, I don't want to get involved in those things, but if you do look at the new Reserve Bank boss, it does look like Caitlyn Jenner. Right? If you take a look at both of them, you're like, "Wow, is this Caitlyn Jenner? Is it?" Maybe it's the thing, but who knows? It doesn't mean anything to me. I don't care about what's happening with the interest rates. What day will they go up? What day will they come down? I've said it beforehand. It's a pinch. It's a pinch on everyone's budget at the moment, right? One thing that I'm very confident of, and I've seen over the last 24 months, specifically the more that they've been going up, is I actually, for those of you that are watching here and don't know what I do here at Be Invested, I run an investment firm where I help people build property portfolios and build wealth and buy properties below market value, but also run a suite of other businesses. And one of those businesses is a property management firm. And looking at the rentals out there, the average property that might be worth 150, 200 grand purchase price was renting for $300, $280 a week. 280 was the sort of average rental before this started happening. Those rents are now $400 a week. So it's $120 a week increase in the last 12, 24 months. And you think about it, what's the increase in the interest rate, but what's happened with the rental market out there and the cash flow? So it's been very fortunate for some that their rents have increased, and is having the right strategy, the right properties, as well as being on top of those rents. It's very interesting, and exciting for a lot of people. But there's a lot of people that are hurting out there as well. So, do I care what's happening with the interest rates? They will be coming down. When they do come down, there is one direction of how hard and how fast they'll come down. And I think I will cover some of that in this next article. So Lisa just asked, have you seen Kate? I think you're talking about that Kate, the William and Kate jig, right? I haven't, but I like looking at people and not at other sort of lizard people things. So I haven't seen that, right? So if you know what I'm talking about with lizard people, you know what I'm talking about. If you know, you know. This one here is very, very crucial. This is hot off the press. Bank of Japan ends the world's only negative rates regime in a historic move, abandons yield curve control. Very important, right? Very important. The BOJ, which is the Bank of Japan, raised short-term interest rates to around zero. The Bank of Japan raises short-term interest rates to around 0%, right? Oh no, right? Interest rates at 0%. They've increased them. We can't afford the interest rates. It's now zero, right? To 0.1 from negative 0.1. According to its statement at the end of its two-day March policy meeting. I find it interesting that all central banks around the world have now changed their meeting dates to 2 days, right? They've changed it from a couple of hours or whatever on a Tuesday to a 2-day meeting, and they're all in line and lockstep. If you notice that they're all a couple of days before the US Fed meets. So the US Fed will meet over the next 48 hours and they will decide their rates. And basically the US dollar is the base currency for all currencies because that's just what the US dollar is. If you want to trade with your currency, you have to trade in US dollars. So if the US currency, US markets change their monetary policy, well, then there's going to be 6 weeks before you start seeing it occur in other ones. So start looking at the US policies and you'll start seeing things once they start moving. But I just find it very interesting that we're pushed 2 days before they meet. So you're looking at this, it says here, the Bank of Japan, I want to read it again, right, because it's fucking funny, right? The Bank of Japan raised its short-term interest rates to around 0%. What the fuck? Come on. The Bank of Japan raised the short-term interest rate to around 0% to 0.1%. So 10 basis points. So 10% or 1%. According to its statement at the end of today's meeting, the central bank abandoned its yield curve control quick policy, though it is pledged to continue its purchases of Japanese government bonds with broadly the same amount as before. So they're still buying up their own bonds because they're the buyer of their own bonds. That's why their currency keeps dying, but they're treading water. BOJ stopped purchases of exchange-traded funds, ETFs, and Japan real estate investment trusts. Right. So what's that going to do to the Japan markets? It pledged to gradually reduce its purchase of commercial paper and corporate bonds with the aim of stopping this practice in about a year. Japan's central bank raised interest rates on Tuesday for the first time since 2007. So the first time in 20 years almost, interest rates have gone up, ending the world's only negative interest rate regime on early signs of a robust wage gains this year. So Japan is having hyperinflation, they're having inflation, high levels of inflation. So they've had to change their monetary policy, tighten the belt, right, and put interest rates through the fucking roof at 0%. Bank of Japan has caution, though caution is not about to embark on aggressive rate hikes, saying that it anticipates that accommodative financial conditions will be maintained for the time being, given the fragile growth in the world's fourth largest economy. The BOJ raised the short-term interest rate from 0 to 0.1%. It also abolished its radical yield curve control policy for Japanese sovereign bonds, which the central bank has employed to target longer-term interest rates by buying and selling bonds as necessary. The central bank, though, will continue to purchase government bonds for broadly the same amount as before, currently about 6 trillion yen per month. It would resort to nimble responses in the form of increased JGB purchase and a fixed rate purchase of JGBs, among with other things, if there is a rapid rise in long-term interest rates. So when we look at what's happening over there, we need to look at their bond market. I don't have any charts for that today. Maybe I would maybe I will bring those on for next week, but the Japanese bond market is abysmal, right? It cannot support. The Japanese market cannot support a 0% interest rate policy, cannot support a 10 basis point policy, right? It has to stay negative. So pushing it is what's going to happen from these actions, right? But it's interesting to go back and look at the Japanese economy because it's used a lot as a safe currency for traders, and trading currency, it's a in between because it does nothing and it just sits there. So I think if we look at the Japanese economy and overlap it with the US economy and start seeing the levels of debt buying and the problems that are about to arise, we can learn a lot of things. It's a 20 years worth of stagflation, right? But when they eradicate their currency, there's a difference between Japan and the US because everyone needs to base their currency off the US dollar, unlike Japan, which is just feeding off itself. So, and that's why they've got along with it for such a long period of time. So do keep an eye out. There's a very interesting sign that's occurred, and a lot of stress out there in those bond markets. So interesting times. So 2024, we're in uncharted waters. It's been in uncharted waters since 1971, when they removed the gold standard from the monetary supply. But these things are becoming more wilder, more fun, and eventually it's just going to end up with the crashing of every currency that we're working on. So it doesn't matter if you're in the US dollar, the Aussie dollar, the Japanese yen, wherever it is, we're all doomed. So anyway, this one here I touched on beforehand. This article is, I think it's from news.com, from Frank there. Absolute betrayal of the people. Australian living standards in a terminal decline, economists warn. Australia is on track to obliterate last year's record immigration levels as a record population growth sends living standards into terminal decline, economists has warned. Leith Van Olsen, co-founder of Macro Business and chief economist at MB Fund and MB Super, said the figures from the Australian Bureau of Statistics last week suggested the Albanese government was lying when it vowed to bring annual net overseas migration back to a sustainable 250,000 people after a projected fall to 375,000 its financial year. Australia has brought in a record of 518,000 net overseas migrants. So let's just go on what does net mean, right? Net means not gross, right? We've probably brought in 1 million people, but maybe 400,000 of them died suddenly, whatever. And then another 100 may have gone, fuck this, I'm leaving the country and going somewhere else. So that's a net figure of 518,000 after, movements around. Data released on Thursday showed a net increase of 55,330 migrants in January alone, the highest January intake ever recorded and more than double the 21,000 recorded last year. So if we think about them, we had a record year last year, right? We had a record year of people migrating to the country of 518,000. And just in January alone, we had 55,000 migrants, right? So January is a bit of a short month based on people, Christmas time, start of the year, whatever, they may not be moving to the country, right? So let's just assume that's just an average month, right? 55,000, that's on track for 660,000 people this year. But they're saying that they're reducing it, right? If we reduce the amount of migrants that we have coming to this country right now, we will be like those other third world countries that are out there, like China and Japan even, or whatever. So I don't mean that as Japan's a third world country, but their financial market is pretty abysmal. So we need to cook our books in order to, show that our economy has got some life left in it. So it's all artificial. It's all artificial positions that we're in. We smashed the goal out of the water, and it tells you that net overseas migration surged higher than its peak from last year, and this 375,000 target is going to be absolutely obliterated. It is just another sign that population numbers are out of control, and it's coming in at the same time as the housing construction is collapsing. That takes me to my next article, which is about builders that are just going broke. So we've got builders that are going broke. We've got businesses that are going broke. We've got inflation going broke. We've got people struggling. We keep adding more people in. It's like people buying toilet paper in the middle of 2020, right? It's silly. It says here, ABS data showed last week that the country added a net of 166,000 homes last calendar year. At the same time, the population grew by $680,000, right? So, unless you're having 4 people per house, there's an issue there. So we only added 1 home per 4.5 new residents. That there, ladies and gentlemen, is why we've got a rental crisis. In New South Wales, for example, For the year to June 30, 2023, the population increased by 173,000, which was 100% driven by net overseas migration. Net overseas migration was actually 176,000, but you lost some residents, so 3,000 people left New South Wales and went to another state. New South Wales housing stock only increased by 44,000 over that same period. So New South Wales added one home for every 4 new residents, actually a bit better than the national average, but it's still shocking. New South Wales Premier last week blamed the astronomical cost of housing for many just up and leaving over the last recent years, and warned the cost of the mass exodus will be severe. If you've got so many young people up and leaving, then they are not joining communities, starting businesses, going to the pub with their mates, and you get a little bit older, becoming the coach of the football team, he said. Domain last week reported a record low national vacancy rate of 0.7%. Which used a different methodology, and also reported a record low of 1% in Brisbane. The makeshift tent cities have begun to grow as the crisis escalates, mostly in Brisbane, but you're seeing it everywhere. People have to live in their cars, group housing, said this guy. It's 100% driven by the federal government's extreme immigration policy. What every listener should be thinking about themselves is, why is the government importing unbelievable record numbers of people into Australia without a plan to house them and provide infrastructure? Because we're seeing the direct results here. So, yeah, I don't think I need to say anymore. It is good in some instances and bad in a lot of others. I know that when I drive on the roads to my office like I did this evening, I know when I drive to places, I don't like my roads that I'm driving on, and I prefer to drive outside of peak periods and whatnot. But a weekend would not be a peak period, but there's too many cars driving on our roads. But it's interesting in itself from that perspective. I guess I can always up and leave and move to a different location. I've got lots of locations to move to. But ultimately, all of my assets that were purchased all these years ago have got considerable amounts of growth that are behind them. So am I happy about it? There could be other ways to make wealth out of it, and I'm naturally going to become wealthy from my properties due to inflation and the currency debasement that's happening anyway. However, these things just really ramp things up, and there's no other way for them to cook the books. They've cooked the books for way too long. Our currency's shot, our economy's shot, and it's all just a fake makeshift system. But the good thing is, if you can see the opportunities within that, you can play at that table as well and participate and become very wealthy along the way as well. I'm going to read a few of your comments before I get into my last article and then get into the topic of discussion of the day today. Bo, hope you're doing well, mate. What have we got here? Matt says here, 1 step forward, 2 steps back. Exactly. And I think that Paul said here, where did he say it? They're bringing the migrants to help the labour shortages in building the industry, but creates more demand, flogging a dead horse. Exactly. It's just all a big Ponzi scheme. Surely all these business closures will cause the CPI to come down. Will inflation eventually nosedive and the money printing and rampant inflation, but deflation or crisis first? Zach, that's a good question. And I don't know where it's going to go to first, right? I believe we're seeing some levels of deflation. And if we go back to the previous article talking about the chewing out of the middle class, right? You've got the rich getting richer, and you've got the poor getting more suppressed and oppressed and pushed down. So there is a massive amount of deflation occurring, but there is also a massive amount of inflation. So we're splitting the economies apart on that front. So there will become a crucial break point where they have to do the great print, and everything they're doing at the moment is pushing us closer and closer and closer to a print which will cause massive levels of inflation. So whenever that day is, that's going to be a great day for a lot of people. It's going to be very bad for 99% of the population. Let me just tell you, when we see hyperinflation, 99% of people are going to be wiped out from this. I don't want to be the 99%, I want to be the 1%. So, there's things that you can do to protect yourself and prepare yourself and get ready for it. So Stephen says here, can I reach out to you personally or do your team only reach out? I work one-on-one with all my investors. I personally build their portfolios one-on-one, so I locate the deals and negotiate the deals and give you guidance, not to call it advice, but I give you the guidance on what we need to do in your portfolio to get you to where you need to be. But I can't do everything, and I'm blessed that I've got hundreds of staff in my business which help with processes and all that sort of stuff. So if it's a general chat or if it's coming on board, you'll be speaking with my team. I don't pick up the call and go, hey, yeah, you should come and join Be Invested because of X, Y, Z or whatever. But if you do come on as a client of Be Invested, I am personally the person that gives you the guidance and the strategy to get you to where you want to be. So I'm still personally calling my clients at 10 o'clock at night when I'm walking or going to the gym, speak to my investors on the weekend. I do all the deals that go to my investors that my investors buy, all those ones you see on Instagram and social media. They're deals that I've done and my clients have done one-on-one with me. So just the feedback for you. Hey Nathan, I'm thinking of doing interest only for the first few years of my loan. What do I think of that? I don't give you guys financial advice on that front, but I'll tell you what I do and how I see it. There is a time when you want to expand your position. There's a time when you want to consolidate your position. When building out your portfolio, you want to have the biggest access to your capital today. So if you're paying off, let's call it 10 grand in your property, 10 grand at a 5 or 6% interest rate, you might sell if you sell $500 a year, $600 a year. It's not going to make a big difference. But if you could buy another asset at the early point, then you've got two hooks in the ocean, being able to catch fish and equity, like not fish, but equity and cash flow and growth, then you're going to be far better off as you progress down your journey. So for me, what I did with my portfolio and with all the loans that I've got in my portfolio, I bought them, let's say it's a 200 grand purchase and rent for $300 a week. You leave it as interest only, it covers itself. After 5 years, it turns from interest only to principal interest. In 5 years' time, the rent goes up by $100 a week. That extra $100 rent increase that you've got is now paying down the loan for you in the principal component. So that's how I've always looked at my portfolio. And the other thing as well, if you're buying a property today for 200 grand, you get it revalued next year for 250K. What you need to look at is that you're going to go back and pull the equity out, right? So it doesn't matter if you pay the thing down. You're going to go back and ask the bank, can I get my own money back out, right? But if you've got 10 properties and you're paying $100 off a month or $100 off a week, $100 a week times 10 properties, that's $1,000 a week. That's 50 grand a year. That could be cash flow going into your own pocket, going towards your own expansion. So you just need to look at where you're at. And that's a great segue for our topic of discussion tonight. So I'll get into that very shortly. Stephen says here, cheers mate, need to chat about my recent purchase with another company. Not here to slag off other companies, I don't know what they do. I try to keep to myself in the property space. There's lots of gurus, self-claimed experts that are out there. Be very cautious of that advice that you're taking. But if you do want to have a bit of a discussion, I think there's a link in the description. It's beinvested.com.au/ or hyphen, whatever you call it, discovery-session. So click on the link in the description wherever you're watching this from, book in a chat with one of my team, and then if it's a hairy question or you got need a bit of help and whatnot, my team quite often come to me every day and I'm very available to them. Like they message me at like 2 o'clock in the morning, 10 o'clock at night, hey, check the email, virtual, whatever, and something they need help on, that they can run it past me as well. So this last article that we've got here, home builders keeping buyers in the dark about financials. You need to know who you're hopping into bed with. Goes on to say, builders including Metricon, GJ Gardner, Hickenbotham and Home Group, which make up almost 1/3 of housing starts of the 20 largest builders, are keeping consumers in the dark about their financial health as industry grapples with soaring borrowing and material costs. Parkview Constructions, Coral Homes, Campbell Property Group and Marston also feature in the Housing Authority. The Housing Industry Association's top-ranked home builders, and they've also failed to lodge recent financial documents. So the building companies now keep the questions coming through. I'll get to them shortly. What have we got here? Yeah, I'll get back to your comments. Keep the comments coming through, folks. So the builders they're not showing their financials to any regulator to say, hey, we're solvent, right? So they could have the biggest Ponzi scheme floating around in the back. You've got all these builders going broke, collapsing, going insolvent, trading insolvent, blowing up. Are these builders actually solvent, or is there a bigger Ponzi scheme bubble that's about to brew and bubble and explode? And I do personally think that we're in a time, and if I like to put my conspiracy theory hat on, you'll own nothing, be happy, etc. What I would look at and think about this is that if all the smaller builders are going broke and these bigger builders are getting bigger, we're going to be left with less competition out there and some big giant groups and consortiums, which will end up, I think the next phase of Australia's landscape of building, as we get out of this little cycle into the next one, which will be a hyperinflationary cycle, we'll start seeing construction of crap like they have in China, where you've just got cities of massive amounts of units, so we can bring massive amounts of migrants through and house them in a communist-style environment, which these will be built via some of these large institutional building companies and institutional BlackRock, Vanguard, State Street-style entities, which will be backed by them. So basically anything that's on the stock market will probably be those ones that get bigger and bigger and bigger and gobble up the rest of the market. So remember when you were a kid, it wasn't a corporatocracy out there. You didn't have, you had little hardwares, right? Hardware House, BBC Hardware, Mitre 10, Home Hardware, all of those ones, TradeLink, whatever they are. Now you just have Bunnings, right? Oh, I need something, we'll just go down to Bunnings and get it. You need something, you've got food, you've got Coles or Woolies, right? You don't have Franklin's, Jules, Food for Less, New World Coles, any of those things. You've just got one or two options, three options if you're lucky. And that's a trend that I'm starting to see happening in this building industry. So that will put a lot more pressure on anything that's pre-existing. So I think that it says it all, right? The builders are not showing their financials anywhere. I noticed that our viewers tonight are a little bit on the lower side, and it might be for shadow banning, maybe for whatever. So if you are liking this video and my message that I put out, if you can just smash up a like and maybe share it with your friends to get some more views and play with the Facebook algorithm a little bit to get us some more hits tonight, that'd be tremendous. So going back to your questions, then I'm going to get into the topic of today and discussion of today. Steve says, "Cheers, bro. I owe you a beer, but I don't drink beer." Exactly. I don't drink. So sparkling water is, yes, sparkling water is good. I'll get high off that. So a few of your questions here. Zach says, hopefully we're close to 40-year loans becoming normal. You can just do perpetual interest-only loans, which will take you out for as long as you wish. Bevan says here, I spoke to an agent in Perth who said he has 20 to 30 people on his books wanting to buy anything he has available, and that's not including buyer's agents. Is that still a good spot or too hot now? I was buying in Perth when everything was $100,000 in the CBD of Perth, $200,000 in the CBD of Perth. Now those things have doubled and tripled in the last 2-3 years. There is some decent areas and some opportunities out there in the market, but I am buying with caution. I do have some new markets that I'm investing into, and I like to buy when the markets are soft, and there's always going to be some sort of soft market out there. So be very, very cautious. When you're speaking to an agent, he says he's got 20 to 30 people at any time on his books wanting to buy anything, right? The property just needs to be listed on realestate.com, and the agent has 50 new people inquiring in the first hour, and it sells for over asking price. That's not a market that I really want to participate in. Adnan says here, Nathan, last year I joined another property investment group, but they teach to steer away from townhouses and units. Problem is it's difficult to find freestanding home that is not negative geared significantly. Look, I buy houses, units, townhouses, villas, blocks of units. I did a block of units the other day, 8 units. They were like 300 grand a piece. Average unit price there is $400,000 in this suburb. So, a whole block of units. But for someone to buy a whole block of units, they need to have a shitload of equity. Where do you get the equity from? Could be from a house, could be from a unit, could be from a townhouse, could be from a villa. The numbers have to stack up. So if I said to someone, I find it very arrogant, right? And I was arrogant once on that front, where I would only buy houses. And I got to a point where I bought about 7 houses and I couldn't buy anything else. And I bought a unit, and then I went back to the bank and I could buy another unit. And I was like, shit, I couldn't buy anything beforehand. And I realised that it's a banker's game that we're playing out there. It's not a property game. So I guess the advice and the strategy, my clients' advice, my clients' results are based on the strategies that I implement for them and the backing of my expertise. So there is a direct reflection. I wouldn't say direct reflection because it's not all me, right? I'm just a guide. If you want to take the advice, take the advice. If you don't take the advice. But if you're taking advice from someone that hasn't got that, right, and they don't know their way around the Monopoly board, then you're not going to get too far. So it would be arrogant for me to say there's no money to be made in a townhouse unit or a villa. I've got tens of thousands of examples where these things have gone up, probably at a greater level than houses, units, houses and land component sort of property. So, in my personal portfolio, I have a good balance between houses, townhouses, units, villas, blocks of units, commercial properties, and whatnot. But you need to work out what is the property doing for you. So, let's just say, this is the best way I can say it, is that Birchie's here in his head office and he's got $100,000 for you to come get, right? And the way I see it, let's say it's 50 grand, right? I've got 50 grand here, come get it. You're in Perth or you're in Queensland, right? You go, fuck, I'll get Birchie's office in Sydney. You get to my office and then you say, oh, where's the 50K to go get, right? And I go, there it is over there in a pile, right? You look at it and you go, that's 5-cent pieces. I don't want that shit, right? The reality of it is it doesn't matter if it's 5-cent pieces or $100 notes, right? Most people, when they think of 50K, they want a little box that opens up with a couple of wads of $100 notes in there, and that's your 50K. But if the 50K is in 5-cent pieces, I actually think the 5-cent pieces are better because you've got the copper and the nickel in them, which is worth more value than a piece of plastic with the dead criminal printed on it. But anyway, the thing is that if you're saying no to 50 grand, you need to look at the 50K. That's the result that you're looking for. So I always say to everyone, is it the note that you want or is it the dollar? At the end of the day, you go take it and put it in the bank. You're going to have just digits on the screen anyway, right? But you want the 50K result. So whatever it's going to take in order to get there. And if you can't get there, if I said to you, you could have one box of $50,000 with green notes in it, or you could have 2 boots full of $50,000 times 2 of 5-cent pieces, which one would you take? Would you want to take 100 grand, but you have to fucking lug the 50-cent pieces and 5-cent pieces, put them in wheelbarrows, whatever? It's a numbers game. So that would be my view and feedback on that in a long-winded sort of way. Rob says here, hey Nathan, we have consolidated, ready to replace those assets with other properties. Cool, I'll send you an email a little bit later on tonight, Rob, if you want to let me know as well. Maybe if you want to send me a text or an email whenever you're ready as well, just on what your thoughts are for our next steps. I have to hop on the phone and have another chat with you. But yeah, I think I know where we're at, and yeah, we're good to kick on with those goals. They said, first purchase, these comments are pushing down, keep them coming through. First purchase was in January, recent bail not quite up there yet this month. When can I go again to redo another valuation? Just comes down to the bank, comes down to lending. I'm going to have a chat with the finance team on your front. Maybe you can just send me a little quick email just so when I hop on my computer, I've got it fresh of mind. I've got to remember everything from the feed here today, folks. Yeah, let's have a chat with finance and see what we can do in order to get onto the second property. I said to you when we spoke a couple of weeks ago, or like 2 months ago now, that let's build out a really nice portfolio. Got the first one on the board, and if we can get to second, third, and fourth this year, that would be fantastic in itself. So, Paul says here, South Headland, that's an iron ore rich place, and that's had some boom and bust there. So, it depends on what part of the cycle there is. Sam says here, great work on the Melbourne deal. Thank you. Got a fair few that I've been picking up recently down there, and do have a projected goal date for starting my own financial institution. Good one. Good question. When can I start my own financial institution? Are we talking about a bank? I'd love a bank one day. Financial instruments, that's a different type of investment there. One day, I'm not there yet, I'm nowhere near it, but when I do, I think I've got a very clear eye on how this whole game works, and I think it'll be dangerous. So I've got some ideas. I can't really share it, right? On here. Some of my views and goals, because it's a chess game with those things, right? So, but one day I'll have a bank, and one day I'll have the full financial institution. I've definitely got the books for it. I've definitely got the capacity to do it. And I thought maybe 6 months ago I could have been in a position to push something on that front, but it's getting there, right? It's funny, you manifest things, you put it into orbit, you do actions, you do things that, you go, wow, I've made it here, I've got to a certain point. So it's, we will get there. But on that note, and that would be fantastic. Keep the comments coming through. So tonight's topic of discussion is, what was the heading of it? Was, how does your investment journey differ with age? And someone asked through that they were 45 starting to invest, and they have a daughter that is 21 and starting their journey. Very important to look at like the different ages that we get through. And I have covered on this previously, but I'll go back to the basics, because some of you guys watching and girls might be watching at 18 or 20. And you'd need something different than someone that's 30 or 40 or 50 or 60. So you need to think about, what are your goals today? If you're 18, you might have a lack of income to start off with, but you also might have a lack of deposit, but you've got a lot of time up your sleeve, and equity would be the most important thing, because you'd want to get from that first one to the second one quick smart. So if I was starting off again, I'd be looking at something that's going to be fairly neutral sort of cash flow, but be able to give me the biggest equity uplift so I could get into the next one and the next one. If I was 45 and starting to invest, then I'd want to have a very similar sort of position, but I might have a house to live in at the time of starting off. I might have some equity in that property, so I might have, let's say I've got 200 grand worth of equity in my property, principal place of residence, whatever that may be. There might be 200 grand equity, and I bought it 10 years ago. I could use that as 4 deposits to go and buy 4 properties. So what I have as a different advantage point over my 18-year-old daughter is that she wouldn't have the deposit saved up. She wouldn't have the high income that I'd have at the height of the career at 45. So using that wisely, I could have 4 deposits at my disposal. So what do I need to do with those 4 deposits? I could go buy 4 properties and come back and pull out that equity. I'd want to keep a good balance of cash flow and equity for the future ones and growth. I'd also be looking at my position and thinking, if I'm 45 years old, I've been working for 25 years or 20 years if I went to uni and wasted 5 years in uni and whatnot. And I'd have 20 to 25 years worth of work, maybe even 30 if I was a tradie and I was doing an electronics apprenticeship at 15. And I'd be thinking, shit, I've got a couple of $100 grand in my super, but I don't know what little commie socialist, blue-haired, decision-making, unhinged financial advisor that's the back end got their grubby mitts on my $250,000 saved up in my super fund. I'd be making very interesting decisions based on the fact of, well, I've got 20 years to retirement, and being able to access my super and be wanting to speak to people that could give me some guidance and feedback on that front, to think, well, maybe I've got another 2 or 3 deposits within my super fund. I could buy maybe 3 properties in my super. And if I was to buy 3 properties within my super, then I could look at the benefits of that. And some of the benefits, if I was 45 years old with $250,000 in my super, that could be, that's just saving 10 grand a year in my super for 25 years, right? 250K. Would be, if I was to buy 3 properties at 250 grand a piece, then I'd have 750 grand worth of asset position. If that doubles and doubles again, that 750 turns to 1.5 next boom, and then 3 million after the next boom. And over the next 20 years until retirement, then I could pay off my super property loans of, say, $500,000 or whatever, and I'd own them outright. And there could potentially be some tax benefits for me. I'd have to speak to my financial team around me to see what I could do with my super fund, but there could be some financial benefits there, i.e. Tax minimisation at retirement, paying little to no tax at all, potentially taking those properties that I had in my super fund when I'm 60, selling them off and using that to pay down debt strategies. Those sort of things that I'd be thinking if I was 45 years old, getting started, is what vehicles do I have? If I'm 18 years old, I don't have a super fund with $250,000 in it, so it wouldn't really be, that wouldn't be my thought process at that period of time. But then let's say that, I don't know, every 20 years there's a family member and you've got grandparents at 65, and the grandparents at 65, at a totally different position again. The parents which are 65 might have 20 good years of life. They might be wanting to quit their job, but they don't have time to fuck around and hurt themselves in any sort of market crashes or whatever. So there'd be a different element and level of risk that would need to be assessed into that position. So I'd be thinking, if I was 65, wow, I need to look at cash flow. So it wouldn't be about equity, it wouldn't be about the capital growth, because you wouldn't be able to get loans in through retirement. I'd be thinking at 65, if I was to get debt, if I'm not going to have a job in 10 years or 15 years or 5 years or whatever, I want to make sure this debt structuring that I have would be able to suffice me through retirement. Instead of being forced to have to sell off a property, maybe I could have money in an offset in case things got tough and the market was bad or whatever. People think debt is bad, but if you have access to debt, and access to debt is really, debt is money, that's how they create it. Access to capital is what you want, access to options. If, let's say, the market's crashed at some point, right? You're in your 65 and 70 years old, the market's crashed and your property's gone back in value, or there's a financial crisis or whatever, and you can't sell the property, you don't want to sell the property, but you had access to the cash in your super, in your line of credit, you could tap into 50 grand, 100 grand, 200 grand. Yes, you'd have a loan for it. However, you wouldn't be forced to sell the asset at that date. You would be in a position to go, hang on a second, maybe I could take that asset and utilise the loan at the moment. However, in 5 years' time, when I'm 75, I could sell that asset off, pay out the debt and pay it whatever, and be in a much better position. And I think when people go to retirement, they don't think of all the what ifs, potentiallys, maybes and one days. And property is a wonderful thing because it gives you more options, and it should be providing more options and choices through whatever the next phase of your life is. But you need to look at the long-term view, and you need to think about 5 years, 10 years, 15, 20 years down the track. So what I would also go back and say to the 21-year-old daughter, not 18-year-old, is like, let's say you're 21 today, and let's say your 21-year-old daughter has a boyfriend, right? And in 10 years' time, said boyfriend might be the husband, and there might be 2 kids or a kid. And the daughter may not be going back to work or wanting to work. When you're 21, you should be thinking when you're 31. You should be thinking if you're 45, what's going to be happening when I'm 55, right? So if you're 21, if I was a 21-year-old chick today, and I'd be thinking in 10 years' time I want to have some kids, what would my life look like, right? So is buying a property that's going to be negative geared? Is it going to be something that I'm looking for growth that I can pull out? Let's say let's just say that you've got a 25-year-old boyfriend and girlfriend, engaged, right? And they've got 5 properties each. It would be important to think when buying those 5 properties each, if we get married and have kids at 30 and I'm not going to be working because I'm going to be a house mum or a house dad or whatever, I wouldn't have any tax deductibles. So would you be putting the purchases that are more equity rich into the person that's not going to be working, and putting the cash flow rich properties in the person that's working and having to pay more taxes at that point. So you need to be thinking about, when you're doing the action on the day of purchasing that asset, how's that going to play out in 10 years, 15 years, 20 years time? And is it going to, are you going to be able to keep that asset in perpetuity? Because buying an asset and selling it off, it comes with its expenses, whether it be stamp duty or disposal fees or capital gains taxes. It's expensive to go back and fix something in retrospect. So, yeah, I think going throughout the ages, you need to be thinking, what have you got as your benefit? What have you got going for you on that day? Is it equity, cash flow, youth, capital? What are you lacking at the time? What do you need to go through to the next phase? What's the next phase going to look like? One thing I see with a lot of people, let's just say that people have kids at 30, I'm just going to use that as an example, age. If you're 30 and you've got 5 properties and you're thinking of having a child, well, you should be thinking, shit, maybe I should revisit my property strategy before I conceive a child, because it's going to be very different when I've got one income, right? So let's say dude and chick, and they're having a kid, and you've got 2 incomes and no dependents, right? You've got 2 incomes, 2 people in the household. Then Mrs. off for a year or 2, and you've got a kid or 2 kids, and you're sitting there thinking, okay, now when the bank looks at me, and most people don't think about this, they're like, oh, it'll be all right, we'll sort it out later, or we don't need the debt today, we want to worry about it after we have the kids. Well, if you're thinking about it after you have the kids, you want to make sure before you have the kids that you set yourself up financially, right? That might just be as simple as looking at your debt position, restructuring, pulling out some equity, not using the equity, not going out there and buying another 10 properties. It could just be simply having it there as a buffer in case something goes wrong, God forbid, that you need to tap into it. But you go back to the bank, in a year's time, you've got 1 or 2 kids, you've got a wife, you've got 1 income. So instead of having 2 incomes, no kids, now you've got 1 income, 1 wife, some people might have more than 1 wife, and you've got 1 or 2 or 3 kids. The bank's going to look at you and say, you've got fucking 4 of you living off 1 income. That ain't going to cut the cheese. You don't service anymore. So you need to be thinking ahead. I see people that change their job. I see people that change their career. I see people that go, oh, I'm going to be a contractor now. It's like, oh, that's really good, right? You're working at the same place for the last 15 years, and now you've become a contractor. That's good. You can't get a loan anymore because the bank ain't going to lend you because you're now self-employed and they see you as a business. So it's stupid, I know. But, I think it's important that you do plan for that next phase that you're going into. You need to be planning for the next 5 years, the next 10 years. Where are you going to be at in life? Where is your family position going to be at? What does the risk look like? You don't have kids, you go have kids, your risk looks different after you've got the kids. You've got all these kids at home, and in 10 years' time, they're all going to piss off, and you're going to be sitting there and you want to move into a different phase or a different location or a different city or town or property type. You need to be planning that. I quite often ask people, they're like, oh, I've got kids, they're all 10 years old, right? And I'm thinking of buying the house to live in. I want the dream house. I'm like, okay, you go buy that dream house. Is that going to be a dream house forever? They're like, no, just until the kids finish school in another 10 years' time. And it's like, okay, kids finish school in 10 years' time. Where do you want to move then? It's like, oh, well, then I want to move to the Gold Coast. I want to move to Noosa. I want to move wherever, right? Just using coastal, right? I'm going to move to a farm, wherever it may be. It's at that point that you think, well, if you can't do the goal that you want to have today by having the house that you want today, wouldn't it be better to look at, okay, maybe we just skip that step and move to the retirement home or move to that one, because you can pick that up and add it into your orbit or into your position today. So, don't think and cut yourself short as well that you may not be able to afford your dream home today, but could you afford your retirement house today, right? And you're not ready to retire, but it could be an investment property that you turn into a retirement home in 10 years' time, 15 years' time, whatever the case may be. And I think that you need to be planning, strategizing, mapping out, what that looks like for you, for your family. What risks are you able to take on at this point in your life? What risks will you be able to take on in another 5 years? There's always something. I don't think there's many people that I've come across that couldn't be doing something. There's no one I hear people, oh no, I'll buy a property in a year's time, or I'll look at my finance in a year's time. Well, you're going to fucking waste it. You're going to waste the opportunity. You're going to waste your servicing that you've got at the moment. There's things that you can be doing to improve your position. And you need to be looking and thinking, how can I improve my position and get the next chess piece along on the strategy, the game board that I'm playing in my life. So, yeah, like I guess in short, how does the investment journey change over the years? Are you just starting out? What are the strengths that you have coming to the table? And each person, like if you're 20, 30, 40, 50, 60, you've all got strengths and weaknesses, right? So, have a drink. Been talking a bit too much. I've got so dry. If you're 20, your weakness is you don't have the capital, right? And you may not have the cash flow, right? If you're 30, you might have two incomes, right? And you've got less expenses because you don't have a kid. You might have saved a big chunk of cash and going into a higher income stage. You might be 40, you've got a couple of kids, you've got highest income, you've got a property with some equity in it, you've got some capital behind you. You're 50, a bit better. You're at the 60 and it's like, you're at the fucking peak, right? Like you've got high income, you've got all this cash, you've got your house paid off, you've got all these things. But if I went to a 65-year-old and said you could be a billionaire or you could be 20 and broke, right? I think most people would take the youth, right? So yes, the 60-year-old has something on their side that's capital, but the 20-year-old has youth. And, it's trying to take as much of those things as you can at the stage in your life you're at. And, the quicker you can get to financial freedom, the quicker you can get to where, you want to be. So, what was the other part of it? The last part that I was going to talk about, which I think I've mainly covered, is the goals that you've got at that period of your life. Like you need to be looking at what are your goals, and what can you do to achieve those goals quicker, and what things can you be adding to your life at that period of time to take full advantage. And I see people just wasting decades, right? And I don't say it with a smile on my face because I'm being a dick or anything. It's just one of the things I've seen over 15 years of this business is people going, I wish I got in contact. I saw you on the news 20 years ago. I should have called you then, right? And it may not have been the right time, right? Whatever the case may be. But, the biggest regrets people have is I should have done this shit easier. I should have done this shit sooner. It's much easier than what I thought it was. So, yeah, I guess taking action is the biggest thing. So, I'm going to leave it at that. I've got a few questions coming through. I'll get to your questions. If you guys do need help or advice or whatnot, you can reach out to us. There is the link in the description. You can click on there, and you can basically book in a call with one of my team to see what things can you tweak on your portfolio. My team are most of them, nearly everyone in my office is a property investor. I encourage. Do you think you're going to fucking work at being invested and not be pushed into buying a property and be like, build your financial freedom? I've had teenagers that have come to me when they're like 17 and work for me. They've got 10 properties, 15 properties, and you see them on the news. They've got like 100 properties, right? It's when you're speaking with my team, you're speaking with people that are achieving the same goals as what you are. Paul says here, I'll take 20 and broke. Thank you. I would take 20 and broke. If I could take myself back to 20 with my brain of today, fuck, I would be dangerous, right? I would tell you straight up, I would be straight out dangerous. Because knowledge is the most important thing, and applying that knowledge is important. Kane says here, do you think we're headed towards an event like the Jubilee 2000, but for the Western world? Thoughts and effects. A debt jubilee is a certain thing. A debt jubilee, I don't think we're going to get forgiven of all our debts, but definitely via hyperinflation, they become a lot less relevant. So debt becomes relevant with inflation, and the greater the severity of the inflation, the greater the velocity of inflation, the quicker those debts become more forgiven. And a debt of today is, most people's loans of 10, 15 years ago are the size of a car loan today. People are taking out car loans the size of a house loan 10, 15 years ago. So, the debt becomes relevant with inflation. So, what other comments? Where are we? My screen's playing up on me here. Correct, Josh. That's what I just said there as well. So true. People don't. Not many people have goals. Most people plan more for their next holiday or the next. It's Thursday coming up. It's late night shopping. What are we going to spend our money on? What are we going to party this weekend? What's our event we're doing? People spend more time planning that shit than what they do planning their escape from the system that they've been enslaved into since the day they were born. And I literally mean that from the day that you're born, without getting too far into thoughts on how the system all works. The day that you were born, you get given a birth certificate, you get your life signed away by your parents, and for good or for bad, you're getting signed away to the state, the system. You go to a state-owned indoctrination system that teaches you to be a good little debt slave, pay your taxes, all those sorts of things. And no one sits there and goes, this is how the fuck to get out of there. I say things that are very abrupt and frank and candid along the way. And it's not to be a dick, but it's just to be thought-provoking, I guess, to be able to go, what can I do to change my life? And not many people plan. That's why not many people get out of that system, because they're trapped in the system and it's too comfortable to be in the system. I think George Carlin, or whatever his name is, said that people are so scared of their life, they've got everything taken away from them, that they're like, leave me, right? It's like, it's uncomfortable. People are like, just leave me. I don't have anything else to take from me. But once you can remove yourself mentally from that and be like, shit, I'm not happy with this. I need to change it. Right, that's when you start working out a hustle to be able to get yourself out of that hole. So work out, what does my escape look like, and what things do I have going for me? It doesn't matter what point in your life, you've got different things that are going for you, and different things that you can do to get ahead and push yourself to the next level. Zach says here, should we fix our rates before hyperinflation kicks in eventually? As if rates are higher, you can still pay off the mortgage without paying the break fee, as long as the rates are higher than what you fix it at. Yes, there will become a point when I would want to fix rates, because I don't think anyone is going to see, like the policymakers might see. There might be a few smart people out there, but I don't think the general populace will, because everything's based off markets and bond markets and yields and stuff like that. I don't think people will realise that they're going into a hyperinflation at that point. So there would become a point. I'm not concerned about fixing my interest rates. And one thing about fixing interest rates as well is that you get discounts, right? So if you're on a standard variable rate's like 9%, right? And then you get all these discounts to the bank, and interest rate 6.5% because you've got a 2.5% rate discount. If you go into a fixed rate product, most banks' fixed rate product removes that special discount. So when you come out of your fixed rate product, you are now at the standard variable rate. You have to go back to the bank. It depends at their discretion if they're going to give you that discount. So for me personally, there'll be a point where I want to fix my rate, but that won't be until our rates look like the Japanese economy there. So, yeah. Couple last questions, and then we will wrap it up. Andrea, thanks, Nathan. Great examples. Glad you enjoyed that. Pat said, "Evening, everyone. Good session today." Thanks, Pat. A lot of people know who Pat is. I saw Stephen there beforehand online. These are my team that are, investors themselves that are here to help you guys with your journey. So, Joe says here, where do you see the Sydney unit market heading in the next 3 years, considering unit prices haven't moved much and house and land prices have declined significantly? I think there's going to be a massive push. I said it before and I touched on it beforehand. I have these numbers, I have these knowledge, I know the inside workings to these institutions. There is a big push for these building and these large ASX listed institutions to push more units out rather than house and land, because there's less land and less housing to be able to be built. So they're going to be pumping the unit market. I believe in the next decade we're going to see the streets littered with units. However, that will drag up with inflation. So the existing units will get dragged away with it, because people will be like, what, it cost me $2.5 million for a new unit and I can't afford that. I'm going to spend $1.2 million on a 25, 30, 40-year-old unit. I'd rather buy the old unit than a new unit. So I think There's only two markets in Sydney that I would touch, and that is there's some units in some locations. If they're cheaper than what they were 10 years ago, great. And the other is total opposite end of the spectrum, which is in globo sites and large development stuff, but it brings no cash flow yield, no return for you. But if you have the capacity to do that, then there is some opportunity out there. So, got here. Cheers, Nathan, for another great Facebook Live. Thanks for sharing the knowledge. Appreciate the insights. Thank you. Awesome as always, buddy. Thank you, Harpreet. Cool. Got Pat here. And then we have got a question here about someone that is no longer here. That is more of a question for an offline discussion about that. People don't always. The question was about a staff member that left. With a lot of love for the staff member. Sometimes people have goals they want to do themselves. Sometimes things don't fit and work, and that was just one of them. So yeah. Not everyone's here forever. I've got staff that have been with me for 11 years, 12 years. I've got people that have been here for 6 months. I've got hundreds of staff throughout all my different businesses, and lots of great talent that I've seen over the years. And we're only as good as the people we have around us, and I like to make sure we've got the best people around us and try to keep those people, but not always does that work out the way that you want it to. So that's sort of may or may not answer that question, but they're no longer here, that person. So, but with that, on that note, I appreciate you spending 1.5 hours with me on Tuesday night tonight. I'm going to leave it at that. If you need help on your journey, working out your plan, working out your strategy, reach out to my team. We're achieving awesome results for investors, whether it be just tweaking up the rents on people's portfolios and getting extra $500 a week or $1,000 a week for their position because it's underperforming. Whether it's restructuring something in your portfolio, whether it's saving you that interest rate, whether it's pulling out the debt, whether it's restructuring your debt, whether it be acquiring the new assets. There's awesome deals out there to be had. I've never been busier. My team has never been busier. The portfolios that we've been building have never been such on large scales of what we're doing, and lots of cool results out there. So if you do need help, reach out to us. Link in the description. Hit us up 1300 367 925. Email us at admin@beinvestor.com.au. We'll catch up soon. Bye for now, folks.